Bureaucratic control. Management audits, budgetary controls, and financial controls are all examples of bureaucratic control that we will be looking at in some detail today. Management audits are evaluations of the effectiveness of systems in an organization. This can be internal or external audits. External audits are conducted by outside organizations such as a licensed accounting firm, CPA firm, or one of the big four, that is PricewaterhouseCoopers, Deloitte, Ernst & Young, and KPMG. Internal audits are conducted by members of the organization on itself. This can be periodic reviews by management from within the same department or an outside department. While external audits provide feedback control to identify legal and ethical lapses that could harm the organization and its reputation. Internal audits review the past, present, and future for any risks. Budgetary controls are the most common form of control for managers. Budgets limit behavior by limiting the resources available and necessary for tasks. The process requires investigation to ensure funds are being used appropriately and the results correspond with the budget. Deviations can be remedied by adjusting the budget. Budgets are most commonly viewed as financial controls but can control other aspects of the organization as well. Marketing and sales frequently track performance in relation to a budget. These considerations are normally held by the chief financial officer of a corporation. Types of budgets are sales budget, forecast of sales by time, product type, and region. Production budget, physical units produced and the availability to produce these units, including manufacturing capacity and resources available. Cost budget, list of expenses without revenue such as human resource and marketing. Cash budget, essential budget of the amount of anticipated receipts and expenditures, working capital, and free cash available. Capital budget, cost of assets including upkeep of buildings, factories, delivery systems, and etc. These are viewed as investments because they are integral to functioning of future businesses. Lastly, master budget, combined budget of all major aspects of the organization. Today's business requires a new method of cost accounting rather than a hierarchical model. Thus, activity-based costing allocates cost based on business processes. It is a more flexible model that focuses on the classifications used within or by the organization rather than a strict model that groups processes together. This better accounts for support services that are related to many different departments and processes. It presents a much clearer picture of the cost of an organization in a way that is easier to achieve cost-benefit effectiveness. ABC identifies streams of activity and then allocates costs across particular business processes according to the amount of time employees devote to particular activities. What are the interpretations? The percentage laboratory services spent in supervision and the percentage that goes to support services Dr. Lane's practices. This brings us to pertinent questions such as how to reduce the highest cost activity. Is it too high compared to the total benefits? What are the corrective actions to be taken? Let us look at the third form of bureaucratic control. An example of financial control is balance sheet that shows the financial picture of a company at a given time and pits assets and liabilities against the current stockholders' equity. Assets are the value of items the corporation owns. Liabilities are monies owned to others. The stockholders' equity is the amount occurring to the corporation's owners. Assets must equal liabilities plus equity. Another example of financial control will be the profits and loss statement. It is an itemized financial statement of the income and expenses of a company's operations. Yet another example of financial control is financial ratios. These are used to check the overall performance of a company. The key ratios are computed from selected items in the P&L statement and balance sheet. Some examples of ratios include liquidity ratios, leverage ratios, and profitability ratios. Liquidity ratio indicates a company's ability to pay short-term debts. Leverage ratio shows the relative amount of funds in the business supplied by creditors and shareholders. Profitability ratio indicates management's ability to generate a financial return on sales of investment.